Welcome to this edition of the Well-Caffeinated podcast. In past episodes, we have covered lots of breaking news topics for fund managers, including the implications of artificial intelligence, the retailization juggernaut, and trends in the booming secondaries marketplace. In today's episode, we're going to take a step back and have a conversation about one of the first principles of fund management: identifying and managing conflicts of interest. Joining me for today's conversation is my partner, David Nicolardi. David is a partner in Freshfields Washington, D.C. office, where he advises private fund sponsors, investment advisors, and financial institutions on SEC regulatory, compliance, and enforcement matters. Before joining Freshfields, David served as branch chief in the SEC's Division of Investment Management, Office of Chief Counsel, giving him a unique perspective on how regulators think about conflicts of interest and investment advisor fiduciary duties. David, the name of the podcast is Well-Caffeinated, so I have to ask you the obligatory question at the start. What's your beverage of choice this morning?
Thanks, Tim. It's great to be here. This morning, I'm drinking a cold brew to keep cool and caffeinated on this hot and humid DC summer day.
That's great, David. For the record, I'm having my usual iced grande skim latte, so I'm well caffeinated and I'm ready to start. So let's get started. Let's go to our first question, David. When people hear the term conflicts of interest, they often assume that someone has done something wrong. Are conflicts themselves the problem, or is the real issue how they are identified and managed?
The SEC, at times, would take the position that some conflicts of interest are so severe that disclosure and management are not sufficient. They need to be eliminated. But this is for the more extreme cases, more egregious conduct. More generally, I would say that while the ideal may be no conflicts of interest, as a practical matter, some conflicts are likely to exist. And thus, the real issue is how conflicts are identified and managed, or not identified and mismanaged. The identification and management of conflicts of interest requires attention and judgment. I'm going to talk about each of these briefly here and more throughout the podcast. But first, identification. Investment advisors should spend time early in the process when they're creating their operations or launching a fund to identify conflicts of interest or potential conflicts of interest that could arise. Some conflicts of interest are obvious, but some may not be. SEC guidance refers to something that could, quote, unconsciously influence an investment advisor's behavior in an unconscious conflict. Investment advisors should take time to identify the sources of revenue and to think about the incentives that they create. Investment advisors should also be forward-looking and think long-term. Conflicts can develop over time as a fund or investment advisors' operations evolve. So thinking not only what are they going to do now, but what are they going to do in the future, other funds, other business lines. Next is management, which really has two components. First, disclosure, and second, mitigation. We're going to talk a lot about disclosure more, but fundamentally, disclosure needs to be full and fair. Is disclosure complete, accurate, and timely? Mitigation can be achieved through policies and procedures, but to be effective, policy and procedures must be appropriately drafted and designed. They also should be tailored to reflect the investment advisor's actual practices and the risks that they may pose. Policies and procedures also need to be applied consistently. As a practical matter, this application should be documented. There should be testing and monitoring to confirm that policies are being followed and working effectively, and there should be reinforced with periodic training to key personnel. Where investment advisors can run into trouble with conflicts of interest is if they don't put sufficient thought into identifying conflicts, treat conflict of interest as a mere speed bump to be passed over or rushed through with as minimal thought as possible, or try to use generic disclosure and off-the-shelf policies and procedures that are not properly tailored to their actual practices.
Thanks, David. Let's dig a little deeper into the identification point that you brought up. Investment advisors owe fiduciary duties under the Advisors Act, and they typically have contractual obligations under partnership agreements, side letters, and other governing documents with their investors. Can you explain how these different obligations fit together when a conflict arises?
Tim, you mentioned fiduciary duty, and that's critical to underscore. The fiduciary duty includes a duty of loyalty that ties directly into conflicts of interest. Importantly, this fiduciary duty cannot be waived. Attempts to do that through advisory contract language or otherwise will be subject to SEC scrutiny and potential ramifications. Section 206 of the Advisors Act prohibits fraudulent conduct or misstatements. It was the basis of the Supreme Court's capital gains decision, saying that investment advisors owe clients a fiduciary duty and must provide full and fair disclosure. Section 206 also has a provision explicitly requiring prior written notice and consent of a principal transaction and allows the SEC in Section 206(4) to develop rules to manage fraudulent conduct. In 2019, the Commission issued its interpretation concerning the standard of conduct for investment advisors, which elaborated on these fiduciary duties, including the duty of loyalty. So there's an overview of the law and the regulation. But as you mentioned, that's only the starting process. There's the LPA, other fund documents, and the side letters. These can create additional obligations, additional limitations, and additional expectations of the investment advisor's conduct. If the LPA says investments will not be concentrated more than a certain percent in a sector or in an issuer, that is a contractual obligation that needs to be followed. If it says certain disclosures will be made periodically or reports given, again, that needs to be followed. And if it says certain things need to be approved, that also needs to be followed. Managing a fund in a manner that contradicts these fund documents could be deemed a breach of fiduciary duty, could be deemed fraudulent conduct, could be a conflict of interest if there's a benefit to the investment advisor for doing so. And thus it's important for investment advisors to know what the fund documents say and to follow them and to have mechanisms in place to do that. On the other hand, fund documents can also provide a means to manage conflicts of interest. And for example, is by creating a limited partners advisory committee or LPAC that can review or approve transactions or conduct that is a conflict of interest. LPAC can be critical to managing conflicts that arise after the fund is launched. I mentioned earlier how conflicts can evolve over time. You may not be able to identify all of them up front. So having that LPAC and having fund documents drafted to provide flexibility to handle unexpected conflicts of interest can be very beneficial, and thoughtful drafting is crucial. The investment advisor should also be diligent in forming that LPAC and developing a rhythm and working rapport early on. So there is a degree of familiarity and trust when conflicts of interest requiring LPAC approval arise.
David, I loved your reference to speed bumps. I had to drive over a number of those in downtown DC this morning on my way to the office for this podcast. You said that some managers treat conflicts of interest as speed bumps and they drive over them as quickly as they can, rather than seeing them as difficult situations that require careful judgment. Why is that such a dangerous mindset?
While it may not be possible to eliminate all conflicts of interest, treating conflicts of interest as speed bumps can be dangerous or short-sighted for various reasons. First, being thoughtful about conflicts of interest is a fundamental part of the fiduciary duty that investment advisors owe clients. You mentioned that this morning at the start of the podcast, and it's true. An advisor is a fiduciary, and managing conflicts of interest is fundamental to fulfilling that fiduciary duty. Second, conflicts of interest have significant regulatory implications. Conflicts of interest are a frequent topic of SEC exams, exam risk alerts, enforcement actions, and enforcement investigations. This is true over time and across different SEC leadership. And looking at the current SEC's actions will illustrate this point. One of the first private fund enforcement actions by the current commission concerned conflicts of interest related to deferred transaction fees paid by portfolio companies to the investment advisor. This was the TZP asset management action from about 1 year ago, which we've written about separately. Earlier this summer, the SEC brought settled enforcement action against an investment advisor for allegedly failing to disclose conflicts of interest that it had in investments in sub-advisors that it recommended to advisory clients, and failing to disclose other affiliate relationships. And just a few weeks ago, in the Simplify settlement, the SEC brought an action against another ETF advisor related to, among other things, engaging in conflicted transactions with affiliates that are prohibited by the Investment Company Act. And last, in June, the SEC staff issued a risk alert that was focused on conflicts of interest and concerned examination observations of investment advisor obligations related to economic conflicts of interest. So this is a priority of the current SEC, and we expect to be a priority across SECs. Third, there are important investor relation considerations here. Investment advisors want to build long-term relationships with LPs, so LPs may invest in a future fund, collaborate with the investment advisor in future projects, and stick by the advisor in the fund if times are challenging. An LP that feels an investment advisor is not fully considering conflicts of interest or feels run over in a process of a conflicted transaction is going to be less likely to invest in that advisor's future fund and to be a long-term collaborative partner with that investment advisor. And in a few instances, in rare and potentially extreme cases, we've seen investors actually bring private lawsuits against fund managers where the process could have been handled better or they felt the process could have been handled better. Last, to reiterate a point that I made previously, not all conflicts are obvious. Some can be subtle or rise over time. If you view conflicts as a speed bump, you may be missing the full consideration needed to identify these. Treating conflicts as a speed bump up front can have significant negative consequences down the line, such as conflicts that are not identified, fund documents or procedures that are not drafted in a way to provide enough flexibility for investment advisors to address conflicts of interest that may arise in the future.
David, disclosure is often the first answer people think about in the context of conflicts. When do you think disclosure is enough, and when does a fund manager need to go further by obtaining approval from its investors or from an LP advisory committee?
Well, in some instances, disclosure will not be enough. Applicable law or the governing documents, which we talked about earlier, may require approval. If the LPA says the LPAC, quote, shall approve certain conflicts or conduct, the manager needs to follow the LPA and get that approval. We also mentioned Section 2063 and principal transactions that requires written notice and client consent. In other instances, whether disclosure is sufficient will be a judgment call based on a variety of factors. For example, was the conduct or the conflict of interest disclosed prior to the investor making the commitment, such as the PPM or the due diligence process? There's a much stronger argument that there was investor or client consent when the disclosure occurred pre-commitment and the investor still chose to proceed with the investment. Another thing to consider is how specific was the prior disclosure of the conflict or conduct at issue. The more detailed the disclosure, the more the disclosure aligns with the actual conflict, the stronger the argument that disclosure was sufficient. But if you're relying on a more general disclosure or penumbras of the conflict being disclosed, that may weigh in favor of getting formal approval rather than relying on disclosure. Last, the magnitude of the conflict is relevant. The SEC is currently focused on investment advisors' disclosure of, quote, material conflicts of interest. In other words, did the conflict cost the fund or investors actual money in terms of reduced returns or increased costs? If so, how much? And how large was the benefit to the investment advisor? While this is not entirely a numbers game, numbers do matter in assessing the materiality and thus deciding whether pre-existing disclosure is sufficient or whether to go the extra step and seek the approval from the LPAC or the investor.
David, earlier you used the term informed consent. When a manager is seeking investor or LPAC approval, what does informed consent actually look like? How much information should be provided to investors so they can make a meaningful decision in your view?
I'm glad you mentioned informed consent, Tim, because that builds on what we were just discussing. It's a very important concept. It's referenced frequently in the Commission's 2019 interpretation that I mentioned and other SEC sources. Informed consent means the disclosure must provide sufficient information so the investor or LPAC members can understand the nature and the scope or extent of the conflict and assent to it proceeding. In assessing whether disclosure is sufficient to facilitate informed consent, the investment advisor should consider, does the disclosure fully and accurately disclose the activity or facts related to the transaction at issue? Does the disclosure identify the nature of the conflict and the magnitude and implications? Could a reasonable investor or a reasonable LPAC member understand the conflict based on what's been disclosed? Two examples from SEC guidance and enforcement actions are instructive here. First is the use of the word may. It's not sufficient for an investment advisor to say that it, quote, may engage in activity that presents a conflict of interest when that investment advisor actually engages in that activity. That's clear from the 2019 Commission interpretation, from various enforcement actions. It was reiterated in the staff's recent risk alert on investment advisor conflicts of interest. Where an investment advisor engages in conduct that presents a conflict of interest, the advisor should say so. It engages in conduct. It has engaged in this conduct and may or will or expects to engage in the conduct in the future. Saying may when it's something you're already doing is going to be scrutinized and has and can be the basis of enforcement action. Another illustration here is in 2023, the SEC brought an enforcement action against American infrastructure funds that related, among other things, to conflicts of interest in a continuation vehicle transaction. What's really important to note here is the investment advisor did go to the LPAC regarding the transaction which would transfer assets from one fund to the continuation vehicle. Nonetheless, the SEC alleged that this disclosure was not sufficient to facilitate informed consent because the investment advisor, quote, failed to disclose to investors the full nature of the transaction and the resulting conflicts before the transfer. Some of these facts that were not disclosed adequately in the SEC's view was the resulting lockup and illiquidity of the investment, and that the investment advisor received additional compensation for the transfer. So these are two illustrative examples of what informed consent is and what kinds of disclosures are not sufficient to give informed consent. Ultimately, fundamentally, can the investor or can the LPAC understand the nature of the conflict, the relevant facts, and make a conscious decision that the transaction or the conflict should be allowed to proceed?
Conflicts of interest can take many forms in the context of a fund. Some of the conflicts I'm used to seeing in my practice are warehousing transactions and principal transactions, cross fund trades, continuation vehicle transactions, allocation of investment opportunities among funds, and allocation of fees, expenses, and operating partner costs between the fund and the fund manager. Can you walk us through how we should think about each of these conflicts and how fund managers should approach them?
The conflicts of interest that you mentioned are frequently raised by the SEC staff in the risk alerts and exams. These are the basis of enforcement actions. They are the conflicts that do often arise, and some of these are conflicts that can't be eliminated. So that's where you identify them and have management and disclosure in place for them. Each of these situations raise potentially significant conflict of interest considerations, and they each present their own set of challenges. For some of these conflicts, the greater challenge typically relates to managing the conflict and having the procedures, the measures in place to execute that management. For example, fee calculations and offsets. Investment advisors know they can't charge funds more than what the documents say. But the challenge relates to calculating these fees accurately. And this is where familiarity with the fund documents is critical. Having policies and procedures and monitoring upfront are critical. So fees and expenses are properly charged from the beginning, ambiguities or errors are addressed early, and refunds are given where appropriate, rather than snowballing over time. On the other hand, allocation of investment opportunities and continuation vehicles often present some of the thorniest issues and require one or a series of judgment calls. Investment allocation goes to the core of an investment advisor's business, picking investments that will help facilitate or achieve clients' objectives. Often, an advisor will have more than one fund or more than one client that have similar investment strategies, and an investment could be suitable and appropriate for more than one strategy. So there's just facts that are creating a potential conflict right there. In addition to having disclosure upfront on investment allocation, conflicts of interest in this area are best handled with a combination of mitigation measures. These measures include, first, policies and procedures related to investment allocation. These policies should provide parameters or factors that the investment advisor can consider in making allocation decisions, but without being overly rigid and inflexible, which could create its own set of problems down the line. Second, a committee or group that confers on allocation determinations. This can facilitate robust discussion and consistent application of investment allocation factors and fair allocation of investments over time. Third, documentation of allocation decisions and testing and monitoring over time to show that the factors that these policies identify as things to be considered in allocation are being considered, and that processes such as rotation of investment opportunities or allocating pro rata, if policies say that's going to be done, confirming that those are actually done in a manner that over time is consistent with the investment advisor's fiduciary duty.
Continuation vehicles have become one of the defining trends in private capital and funds over the last several years. Why do continuation fund transactions create such unique conflicts for sponsors?
It's another great question. Continuation vehicles, as you mentioned, really have exploded in growth and popularity and in use, and they can be beneficial to both investors and investment managers over time in facilitating their goals and objectives. But there are also aspects of these transactions that can be challenging from a conflict of interest perspective and require judgment or series of judgments and good process. And I'm going to discuss some of these aspects that can be particularly challenging from a conflict perspective. First, the investment advisor is often on both sides of the transaction, managing the existing fund that holds the assets and seeking to manage the new fund, the continuation vehicle, that will take over that asset. The investment advisor, therefore, can have competing interests. A valuation that's higher will be helpful to the selling fund, whereas a valuation that's lower can be helpful to the new fund. Investment advisors may also crystallize carried interest or otherwise shift or move around or offload risk associated with the continuation vehicle transaction. Another thing that's important with continuation vehicle transactions is that time can often be of the essence in these kinds of transactions. And while moving quickly is critical, it's also critical that the process is thoughtful, that investors feel heard, that are given time to consider conflicts, or the LPAC is given time to consider conflicts before needing to approve them. Another aspect of continuation vehicles that may be more challenging in the disclosure sense than some other conflicts is that pre-commitment disclosure can be more limited, or the feasibility of it can be more limited for continuation vehicles. You can give some disclosure in your PPM or in your ADV that continuation vehicles will be considered as an exit strategy as a fund approaches the end of the term, and that can pose conflicts of interest. But you're typically not going to know upfront, pre-commitment, that there will be a continuation vehicle, or which fund, asset, or assets are going to be transferred as part of the continuation vehicle, or what the terms of the new continuation vehicle are going to be. That's where having this flexibility and the process and the LPAC to deal with the conflicts of interest as they arise is important. While pre-commitment disclosure can be helpful, it's not typically going to be sufficient because of these variables that I mentioned. Continuation vehicles are also entwined with questions of valuation. That itself is an issue that can be substantively challenging for investment advisors and present conflicts of interest. The securities at issue are typically illiquid, hard to value. Different market participants could value these securities differently. The subjectivity of the valuation presents its own potential conflicts of interest because valuation can affect the investment advisor's performance fee and track record. In addition, as I mentioned earlier, a higher valuation can benefit the fund that holds and is selling the asset. Lower valuation can benefit the fund that's acquiring the asset. There are these competing interests. Note here the Commission is focused on valuation practices and disclosures, not just in the context of continuation vehicles, but that is one area. Earlier this year, it settled enforcement action against a private fund advisor related to valuation of illiquid assets involved in principal transactions during times of market stress, where the valuation methodologies that were being used didn't reflect the conditions and the stress and weren't consistent with what the advisor said it would do in terms of valuation.
David, I'm going to ask you to role play a little bit. Suppose you're advising a fund LP advisory committee. What are the key questions every LPAC member should ask before approving a conflict transaction?
This is a great question. And in answering it, I would be cognizant of our earlier discussion regarding informed consent. What do I need to know as an LPAC member to understand the nature and extent of the transaction and the conflict? And what are the relevant facts around it? One area of focus would be on the transaction itself. Are there alternatives to the transaction? If so, are the viable alternatives given fair consideration? Why is this transaction more appropriate or better than the alternatives? In the continuation vehicle context, or other liquidity solutions for the asset or assets explored would be better for the fund to extend the fund life instead of doing the continuation vehicle. Next, I want to know how is the investment advisor and how is its affiliates benefiting from the transaction? Is the investment advisor crystallizing carried interest or offloading some of its own risk by the transaction? Would an alternative to this transaction provide the same benefits to the investment advisor and its affiliates? And quantitatively, how large or significant is the benefit to the investment advisor and its affiliates? Third, I would inquire regarding the process. Did the process for this transaction follow the LPA and the related procedures? Was the LPAC given the notice, given the materials, given the information it would expect and it is entitled to in the manner consistent with these documents? Were third parties consulted with respect to determining valuation or fairness of the transaction? And if so, who were these third-party providers? And were they given sufficient access to information to make their assessments? Are they given sufficient time to do so? Fundamentally, this comes back around to informed consent. Can I understand the transaction? Can I understand the nature and extent of the conflict? Can I be confident that I'm making an informed decision with the understanding of these facts that this transaction is in the best interest of the fund?
Well, that's it for today's podcast. David, thank you so much for joining me today and for helping us demystify one of the most important and practical topics in private funds.
Thanks, Tim.
My rule for every meeting is simple: it's a good meeting if you learn something new, and a bad meeting if you don't. By this measure, I think today's discussion was an excellent one. I hope our listeners come away with a greater appreciation that conflicts aren't something to fear or ignore. They're something to identify early, manage carefully, and approach with transparency and sound judgment. Thanks everyone for listening to Well Caffeinated. Until next time, stay caffeinated and well informed.